Thanks so much, Faye, and Laura, and really Delaware, the Weinberg Center, ECGI, and to all the participants here. We're really looking forward to getting your suggestions and feedback on this paper. As you'll see, this is very much, I think, in the spirit of this competition. And what we want to do is highlight issues that are really still grappling with some deep fundamental problems that we're facing within corporate governance. In particular, today we're going to focus on this idea of ESG, what it means, and what it should mean kind of going forward. So as Faye mentioned, this is joint work with Umit Gurun and Kwok Nguyen. And I want to walk you through kind of what we've done up to this point and what we are thinking of doing kind of going forward and get your take on it. And so look, the idea behind this paper is a simple one. And it's just that ESG investing, and that's true on both the investor side and corporate side, and we'll talk about that. Look, this has been growing. And I don't think I need much motivation here, but the idea is, look, as of 2019, it's made up about 20% of the $46 trillion in US assets under management. And now, how have people implemented this ESG investing? Well, there've really been kind of two ways. And so the first way has been according to ESG ratings. And so they're outside organizations, and I'll talk a fair bit about those. And the second way has been through these divestiture campaigns. Right? These campaigns that say, hey, look, forget about the ratings. We are just going to invest in industries A, B, and C, and we're not going to invest in D, E, and F, right? And who are those D, E, and F? Well, a lot of times they're things like tobacco, weapons, or what I'll be talking to you today about, which are fossil fuels. Okay, and so look, why would you want to do this ESG-based investing? Well, there are lots of good reasons to think you might want to do this, or why some investor might want to do this. You could have a preference-based argument. So the idea there is just, hey, look, these line up with my preferences, right? The things that I think are important in the world. And so I'm willing to take a lower risk-adjusted return from a delegated portfolio manager, mutual fund manager, you can think here, if they deliver that return based on with my preferences, right? In line with my preferences. Or another way to say that is, hey, look, I'm willing to pay more for the same risk-adjusted returns and pay a higher fee as long as it's done according to my preferences. But even if this is not a preference-based argument at all, could be a belief-based argument, right? You could say, hey, look, these aren't my preferences, but I think the world really values these ESG ratings and the things behind them. So what that means is that these firms that value this ESG type motives, they'll get better workers, they'll get more customers going forward, which means more revenues. And so I think they'll be more highly valued firms, and I think they'll be that in a way that the market doesn't fully appreciate. And if they don't fully appreciate it right now, then that means I can make better returns, even if it doesn't line up with my preferences at all. Now, of course, the counter argument is that, hey, whenever you run a constrained portfolio maximization, you're going to do weakly as good and probably worse than the unconstrained maximization. Okay, now the evidence on this is kind of mixed. And part of that has to do with the fact that ESG investing just hasn't been around that long. And so when it hasn't been around that long, we don't have enough years. We know in asset pricing, we need years, centuries, maybe even millennia, until we can kind of confidently say that A outperforms B. We haven't had it, right? So ESG investing hasn't been around that long. And so the results have been kind of mixed on whether this is helping or hurting in terms of this risk-adjusted return. Now, what we do in this paper is a little bit different. And so we turn this lens that we've cared about quite a lot in some of our other work, and that is this innovation lens toward this ESG space. And so we just asked this simple question of like, look, who's actually out there producing green innovation? So right, the frontier that's going to push us toward the solutions that will help the world, who's doing it, right? Who's doing it and who's doing it well, right? Who's doing the best quality of this innovation? And then this really important question, which is kind of the goal of ESG investing, is our capital following that path, right? So are we putting our money where our mouths should be here, which is, are we putting our money toward those producers of the highest innovation and the highest quality innovation? So look, this is what we find. So we find that a large fraction of green patenting is driven not by these highly rated ESG firms, but instead by a group of firms that get quite low ESG ratings and that are the targets of these exact divestiture campaigns. And these are traditional fossil fuel firms. So this energy sector, that's what I'm going to call the energy sector, right? I'll just use that as this shorthand here. They have been doing this not only recently, but they've kind of been doing this for decades. And so I'll show you some evidence of exactly that. So it turns out they allocate significantly more of their entire innovation efforts toward green innovation than other firms, and even than other firms that are active in green patenting, right? So think of two firms that are active there. Energy firms allocate significantly more of their capital to this green investing, and in particular to climate mitigation technology. The green patents they produce are of significantly higher quality, right? And this is important because when we first found that they produce more of these green patents, we're like, yeah, well, maybe they're just doing this to put some points up on the scoreboard, right? Like to be like, yeah, here's some green patents, but they're kind of crummy green patents. Turns out that's not true at all. Okay, it turns out by our markers of patent valuation, they're producing higher value patents, patents that are more likely to be blockbuster patents, and patents that are significantly more cited by alternative energy firms outside of the traditional energy industry. Okay, now with all that being said, these are the exact firms that are excluded from ESG funds, so excluded from that capital. It doesn't look like capital is going to them, either in these ESG directed funds or in these divestiture campaigns. They're specifically the firms that are pushed away. Okay. And on the intensive margin, they're even given less credit for every green patent they come up with, even though, like we find, these green patents are of more high value, right? And so, look, from there, right, our last kind of pieces of evidence here are then we look at the real investment of these firms, because I think this is where the rubber meets the road. And this is where you say, okay, look, it's great that they have these patents and this innovation, but what if they're just doing it to shelf, right? What if they're doing it for, again, not great reasons, that they want to produce these alternative energies that might help us to get to a cleaner world in that sense, but instead they're doing it because they want to block outside firms from entering the space. So think of it, they're creating these things called patent thickets, right, that prevent other people from innovating, or they just want to do it to shelf it, right, and just to signal to the outside, but not actually produce these things. Well, we find evidence that kind of leans in the other direction, which is to say that they are making substantial investments in this space. And not only they are, but I can use that in the past tense, they have been, right? And they were. And so when you look at some of the most important technologies today, like solar technology, I'm going to show you a patent from Exxon that is one of the foundational patents in all of solar technology. And so all solar producers, they cite this patent and they say, yeah, this is a really big one, came around in 1978. And when you look at patenting back in the 1980s, before the word ESG ever existed in our vernacular, these were some of the first investors in this space. Okay, so they've been doing it then, they're doing it now. Some of the biggest projects worldwide come from these traditional energy firms. So if you think of the big wind projects, some of these big solar projects, and there's no evidence that they are doing anything to block others from getting in this space. Okay, and so kind of stepping back, what's the reasoning behind this that could drive this? Well, we think about this in this much more traditional sense of, imagine like a Xerox or Kodak, right? These firms, the traditional energy firms that exist today, they see the future in some sense, right? They see that the future is not going to come from traditional energy, and these are going concerns, right? They want to be these infinitely lived firms. They don't want to be your oil providers for the next 100 years. They want to be your energy providers for the next 100 years. And if that energy is going to be coming from somewhere other than oil, then of course they want to be a part of that energy provision, right? And there's good reason to think that they might be able to help us to get there, given the amount of expertise and experience they have in delivering energy up through the past 100. Right? And so the idea is that market forces would drive them, or might drive them, to exactly the kinds of incentives that we see revealed here in the innovation space itself. And so, look, I'll tell you a little about the sample and how we come up with these results, but we kind of have the main findings in mind as we walk through them. And so we use data from the USPTO. So we use the entire universe of patents going back to 1980. And then on the ESG rating side, we are going to use data from Sustainalytics. And so the reason why we use Sustainalytics is that it is the largest coverage, both in the time series and cross-section. So it just gives us the largest sample in thinking through how this relates to ESG ratings. And what are green patents, right? Stepping back. Well, the nice part is green patents have been defined by the OECD as a certain set of patents. So they, in some sense, have this classification system. And you can think about this as like the Dewey Decimal System, right? Or the Standard Industrial Classification Code. So it's just this system that says, okay, these are what green patents are, and here are the different ways we can think through their classification. And like I mentioned, when you actually look in the meat of these patents, this is what a patent looks like. And this is this foundational patent from Exxon back in 1978. Okay, and so they've been in these important producers throughout really the past 30 to 40 years. Green patenting, and I'm probably will be no surprise to anyone, look, it's been growing, like I mentioned, and growing in this very, very large and ubiquitous pattern. In particular, what we find in this paper is that a big component of that pattern have been these energy firms. And so I highlight here, it's a little bit hard to read, but these are these traditional energy firms. You see Exxon here, Royal Dutch Shell, and they're just important players in this space. Okay? And so in thinking through how important they are, I just want to give a couple magnitudes before I wrap up. And that is, you can think about the average firm that's active in green patenting, right? So I'm already selecting on firms that do patent in this green space. They produce about 8% of all their patents go into green patenting, right? So selecting on firms that already patent there, 8% of their patents go into this green patent space. Now that number for energy firms is about 23%. Okay, so about 3 times as much of their innovative fervor goes into green patenting as the average firm that's already active. That's true, especially in climate mitigation technology, right? So exactly thinking through these solutions that are going to help us to get to this next energy solution, right? And while that's true, as I mentioned, it's not rewarded by these ESG firms. And in particular, each patent that these firms produce, these traditional energy firms, is actually not given much credit at all by these ESG rating firms. So even though they seem to have these high value patents, like I mentioned, they're not something that's rewarded by these firms. Okay, and so in thinking about what this means, right, and I'm just gonna kind of quickly jump right to this production. And so what does this mean for the world? Well, it turns out that they are producing quite a lot, like I mentioned, of this wattage in the space. So they're using these patents to do something. And so it begs the question, look, where does that leave us? Where does that leave us looking forward? And so our big takeaway up to this point is that these firms, and I think it's important that the kind of world needs to understand, these firms have been important innovators in this space far before there was an ESG. And now that there are these ESG ratings and that there are these campaigns about thinking through where we allocate capital, maybe they should want to think about how these energy firms can be part of the solution going forward. But that's very different than what has been happening, right? What has been happening are these exact firms that have been an important part of the solution up to this point are the firms that are being excluded. And so our big takeaway up to now is perhaps instead of thinking ex ante saying, okay, these firms can be a part of the solution and these firms can't, instead we can restructure that system, that incentive system, by having a reward-based incentive system that says, hey, look, anybody that can help us get to the solution, why don't we make them part of this solution space? Okay, and so I'm going to end with this kind of picture of, this is that team from Exxon that created that first solar cell. And in thinking about going forward, tying this to cost of capital and other textual-based measures to really tie in this innovation is where we're looking to go. And so with that, I'm going to turn it over to Laura, and I really look forward to getting her feedback.
Thank you, Lauren. And our discussant is Laura Starks from the University of Texas.
Thank you. Thank you very much, Faye. And I want to thank the organizers for asking me to present this paper. I think it's very important for helping us better understand the ongoing energy transition of energy firms, how these energy firms are adapting to the transition, and even more importantly, perhaps, how investors are reacting to both climate risk and energy transition. So the authors have a very clever approach. They have fascinating evidence. They are well deserving of the award, but I would not be doing my job if I didn't find some kind of issues to quibble about. So that's what I will do. To me, there are two primary areas of the paper. One is the cost of divesting energy firms by the institutional investors, and in this case, the mutual funds. And the second is energy transition and what kind of effects this energy transition is having on the energy firm. So I'm actually going to start with the first part about divesting and then talk about the energy transition results. So one question is, well, how much of fossil fuel assets are being divested? And this is a survey that was conducted by Octopus Group of global institutional investors and asking them about their fossil fuel divestments, like their current divestments, and then their expected divestments. And you can see that although, overall there's not a huge divestment, there is expected to be much greater divestments. So then the question is, who is divesting? And this is my first real quibble, because ESG investing is not the same as socially responsible or sustainable and responsible investing. They're very different. So the SRI is based on taste and preferences, and it's centered on negative screening. The ESG can be based on taste and preferences, or it can be based on simply return and risk considerations, or it can be based on both. And so there are a number of different approaches that you see to ESG investing, and lumping them all together into one group, I think should be reconsidered. The author should also consider the different possible reasons for divestment. So this gets into the same issue of who's divesting. One which they have centered on is the preferences, this avoidance of contributing to climate change, where there are investors who want to avoid complicity in climate change. But there's also risk management and return considerations. So for example, there may be diversification considerations. While Norges Bank has divested from coal companies based on their Council of Ethics decisions, they haven't divested from oil and gas companies in general for that reason. They've only divested from the oil and gas companies that have unacceptable greenhouse gas emissions. And there aren't that many that they've divested for that reason that's on their Council of Ethics. So the reason that has been given for the Norwegian Sovereign Wealth Fund to divest of the oil and gas companies is more for diversification considerations than for these preferences. There's also the question of stranded asset risk. How much people are divesting because they're worried about the stranded asset risk, those reserves underground that are not able to be brought up. Exxon wrote down a large portion of their reserves in December because they didn't think they had the value. And then it may simply be sector rotation. So I think the authors should think more about how these issues might affect their results. Then the authors come up with the cost of divestment for portfolios, and I think this is an important part of the paper. Hank Bessenbinder has a paper where he estimates a different kind of cost, a frictional cost of divestment, and finds that they range between 2 to 12% of the portfolio's value. So the authors may want to think about this approach as well. And as I said, they have an additional potentially important cost. Okay, so going back to this problems with expectations of investing in energy sector firms, there's a wide variation in types of energy firms. These are the SIC codes that the authors use to define the energy firms, but a coal company is not equal to an oil and gas extraction company in the eyes of many investors. So I would recommend that the authors separate out the oil and gas from the coal, because investors who've been divesting have separated these as two distinct types. And some are divesting from coal while not yet divesting from oil and gas. Okay, then another issue with the expectations of investing is in the energy firms is, again, like I said, the green funds, they define their set of ESG and SRI funds as green funds. But think about, you have an SRI fund that's focused on animal rights or on no weapons. They may not be focused on removing energy firms from their portfolios. A low carbon fund would be focused on this, but then those investors may not care because they've purposely invested in low carbon funds because of preferences. And then holistic ESG funds that have different ideas of how to invest, with some investing in oil and gas, but then not keeping the ones that they think are the most problematic. So they're not the same motivations. Also, using mutual funds may not provide us with as much information as using institutional investor holdings. And I would encourage the authors to look at the institutional investor holdings, because this may be more meaningful for pension funds, endowments, and foundations. Okay, so now I'd like to talk about this energy transition idea in the paper, which I think is really just a great idea. And the energy transition may be the most important industrial change we'll see over the next decade. So it would be nice if the authors could provide more insights into how the energy firms will adapt to this transition. So I have a possible new hypothesis. That's what's great about being a discussant. You don't have to worry about whether this is even testable. You can just throw it out there and say, y'all figure out how to do this. But the energy firms recognize that energy transition will occur, particularly after the Paris Agreement, and so they must put their efforts toward being part of this transition. So it would be interesting to see whether those with more stranded assets, or I should say potential stranded assets here, produce more patents on a relative basis, green patents. And then also it would be helpful to understand which energy firms are undertaking these patents the most, after obviously controlling for size. The ones who are clearly transitioning, or the others. So it's a different way of dividing it up than using ESG scores. Okay, so another question is, how do the authors define green patents? Lauren has said they use the OECD and they give you a site, and I went to that site, and it's very difficult to understand exactly how this is being done. According to Andrew Ang at BlackRock, green patents by definition are those filed under fields corresponding to the UN Sustainable Development Goals. And BlackRock actually uses these green patents as signals of fundamental intangible value for a firm, and combine those signals with the more traditional value measures to form factor portfolios and achieve alpha. So it would be helpful to understand, what is meant by the green patents. I believe it's just environmental, which means they're using green and talking about the patents only about environmental, but they use green to refer to ESG funds. And some of the patents that are filed under the fields corresponding to the UN Sustainable Development Goals are defined as green, even if they have more of a social effect than as an environmental effect, at least from my understanding. So perhaps breaking the patents further down in their types would be helpful. Okay, so we have this growth in green patents over time. This comes from, I made this graph from their table 1, but if you look at the growth in green patents compared to the other patents, it's astonishing how low that growth has been compared to the other types of patents. And it would be helpful maybe to understand why there is, particularly in recent years, this hasn't been a lot higher. Okay, so going back to the investors, the green patents, it'd be helpful to understand how green patenting impacts the propensity of green investors to invest in the energy firms. Are they systematically avoiding energy firms that are high green patenters? Also, the interaction between divestment and green patenting, there could be another interpretation of the author's results. At this point, the paper simply shows that energy firms pursue more green innovation, but it's not possible to rule out other types of channels, such as it could be that they're being pressured by divestment campaigns or engagements, such as those in Dimson, Lee, and Caracas. Okay, so I'm going to skip this. I'll send the authors. I have some other little picky details. Overall, I think the topic is highly important, that authors have been clever and original, and I'm really looking forward to seeing their future versions.
Thank you very much, Laura, for great discussion. Lauren, could you take a minute to respond to Laura's discussion?
Yeah, absolutely. And so, firstly, Laura, thanks so much. Super great comments, as usual. And look, I think both of these pieces are fantastic and will definitely help strengthen the paper. The first, just better empirical definition. So I love what you say, just getting the more precise, both definitions and then subcategories of each on the fund side and on the patent side. And I totally agree that can allow us just to get a better insight into kind of what's going on in this space, and in particular, what's going on with this climate mitigation technology that we're looking at, and really kind of drill down on those. And secondly, I love the test that you mentioned, and those absolutely are testable in our data, and we're going to do them. And so thanks again so much, Laura. Awesome as usual. Please do send along the slides. And with that, Faye, I'd love to open it up to other questions and comments.
Lauren, there's actually a question in the Q&A box that received a lot of likes. Would you like to maybe expand on that? I know Umid has already responded to it.
Yes, no. I love it. This is fantastic. I love with the upvotes here. This is great. Okay, I feel like I'm going to get a question on GameStop here in a second. Okay, so this is from Fabrizio, I think is the one you're mentioning, right? And so, look, this is something that we think about as well. So let me just I will then kind of encapsulate Fabrizio's question and then how we think through this. So his question is like, hey, look, isn't this kind of obvious, right? This is like what they do. These are energy firms. Yeah, big surprise. They're going to be the ones also innovating in green energy, right? And so in some sense, what was surprising for us, and so I agree with a lot of the spirit of this comment, what's surprising for us is two things. So number one, what surprised us is that they not only have been innovating in this space, and this gets a little bit to Laura's last comment, they were innovating in this space far before there was pressure from ESG, right? And so you might think, all their innovation is just a response to this ESG. You can think about punishment. And in that sense, hey, look, maybe it's a good thing. Maybe it's that fire that's being lit under them that's forcing them to do this. But they were doing this back in 1975, right? Now I showed you the patent from 1978, from 1980, before ESG was a thing at all. And so I think in that sense, that's a nice cleaner period in some sense to see that, look, the reason they were doing it then was not because of ESG, couldn't have been because of ESG, but instead was because they cared about their future and the future of energy. And so I think in that sense, we saw them investing even when ESG wasn't a factor at all. Now, going forward, not only that, hey, look, if it were just a strategic thing on their side, then we might not expect to see that investment and for them to produce such high quality innovation, but instead just to put up some kind of crummy patents just to show they're doing it. But we do see them doing that. And lastly, what we think is important, and Laura mentioned this, I think really well, is that there's that capital response. And so what's important to us as part of the paper is saying, hey, look, capital providers out there, these are really important innovators in this space. And so the fact that you have, and some of these, Laura's totally right, that some of these campaigns are not related, but the ones that are, that have not seemed to be taking this into account, maybe because you don't know, that's really important. Because if the point of your capital is to get us to the solution the fastest, then maybe part of that capital should be coming through them.
Thank you for a great response.
Yes.
Well, actually, I'm gonna abuse my privilege? Well, there's another question. Was actually more of a suggestion. You consider from Caroline Flemmer. She said that you consider the composite ESG rating. While interesting, I think it would be valuable to go a bit deeper and explore the relationship between the E and green patenting as opposed to the S and G. Have you explored this?
Yes, yeah. And so look, that is a great point. And so I zoomed through this, Carolyn. I'm sorry for this. So all of the results of the paper are on the E. Okay, so it's not the ESG, it's just the E. Now, to Laura's point, right, when we look at funds, mutual funds, we've been looking now at green mutual funds, and she's right. If we could get even a little bit a finer of a definition there, maybe even if not through the name, through the prospectuses, on ones that are focusing more on carbon, I think that would be better on the fund side. So I think this spirit, we have it on that left-hand side variable through the E, but more on the mutual fund side would be great as well. So thanks so much.
One more question from John Lukomnik. He was asking to put a fine point on Professor Stark's point about reasons. One of the issues is that you can't invest in only the green portions of BP or Exxon through public equity. However, you can invest only in the green portions through their project finance. You might want to look at different financing mechanisms in the next set of papers on cost of capital.
Yeah, and so John, I think this is a great point. And so we are trying to get at exactly this. So we now have data on all of the green bonds that have been issued. And so these are both public and private bonds. So we want to tackle exactly their question. I think it's an awesome question. And hopefully we'll know soon about these other investments of these firms in green bonds and their cost of capital in this other space.